This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. This is the Definitely Uncertain podcast, and my name is Darren Rockman, and I'm a partner at Gold Rock, the 25-year-old multifamily office servicing high net worth families in Israel and around the world. And today, we are going to look at Australian real estate, and to help us look at that, I am welcoming to the podcast Jonathan Moss and Cyril Pham from Sydney. Hi, guys.
Hi. Thank you for having us. Thank you for having us, Darren.
Thanks for joining. So, Jonathan is a principal at the IJD Group, which is a private family office where he focuses on real estate and real estate lending. He's a member of the Family Office Investment Committee. He's also a principal and portfolio manager of Harbour Credit Partners, HCP, which is a funds management firm specializing in private credit investments. And Cyril, hi Cyril, Pham is a portfolio manager at HCP. He was previously at Lazard Australia Private Equity, and prior to that, he was an investment banker with Goldman Sachs. So, guys, I want to ask you a little bit about what's going on in the Australian real estate market. But before we do that, tell us each of you a little bit about your professional backgrounds and why it was that you guys decided to launch Harbour Credit Partners.
You want to lead off? Sure. So just as you mentioned, I started my career at Goldman Sachs in investment banking, primarily doing coverage of infrastructure, power, transport companies, executing M&A and capital markets transactions for companies such as AGL Energy, Transurban. At the time, some of the listed infrastructure companies were Babcock and Brown and Macquarie. Thereafter, was fortunate enough to obtain a role at Lazard Carnegie Wiley's Corporate Opportunities Fund, which was subsequently rebranded to Lazard Australia Private Equity. Having said that, even though most of the investments within that fund were mid-market private equity oriented, such as the ownership of Dun & Bradstreet Australia, we had a substantial stake in a listed recruitment service business called Chandler Cloud. It did have the capacity to invest across the entire part of the capital structure and also sector agnostic as well, including doing some tangible real estate investments and operating real estate investments such as self-storage and pubs, which was unusual at the time because most private equity firms were prohibited actually from owning freehold real estate in operating companies. I guess one of the reasons why eventually I moved into private credit, Harbour Credit Partners in particular, was one of the portfolio companies which I had a meaningful participation with whilst at Lazard was a business called Scott Business Finance. I sat on the board of Scott Business Finance on behalf of Lazard when we purchased it out of the Orco receivership. And unfortunately, Orco did go to receivership. I guess Scott itself was a non-bank lender, essentially servicing SMEs which were unable to obtain traditional working capital finance from the banks. And in some ways, were lending against trade debtors, or the old factoring speak, against trade invoices. And so in some ways, it's very inimical to the strategy which we're focusing on Harbour Credit Partners, which is essentially asset-backed lending to cheap businesses or situations which are asset-rich, but for whatever reason, they're cash flow poor.
Cash poor, so. Sure. And Jonathan, how did you get, what was your sort of pathway to HCP?
One of, I think, fortuitous circumstance and trial and error. So as I came to the family office, the decision was made, not necessarily for any fundamental reasons, that we wanted to essentially change the way that we invested in real estate and also better diversify ourselves. So that was in about 2016. I came to the family office. We sold quite a few very large assets for the family, resulted in a reasonably substantial. Correct. Resulted in a substantial liquidity event. And during that time, we decided to pivot the strategy to sort of have three pillars. One was a direct investment sort of development strategy. The second was to back other developers, which we continue to do today, and it's probably the largest part of our development portfolio. And the third is a direct lending strategy. And the direct lending strategy happens somewhat organically. As we try to reposition our portfolio and re-enter via sort of direct equity-related real estate transactions, we found that the space has become quite crowded. financial assets were typically treated like financial assets as opposed to operating assets. Cap rates were incredibly compressed. And at the same time, we were starting to see this sort of irregular but increasingly steady flow of senior debt transactions whereby we were earning equity-like returns in the senior part of the capital stack. Right. Now, those returns normalized relatively quickly, especially leading into about 2019. But even in 2019, you were still earning sort of very high single-digit, low double-digit returns in the senior part of the capital stack at a time where equity transactions were being underwritten to sort of 7-8 IRR. So we just decided, why would we do equity when we can sort of earn better risk-adjusted returns than the debt? And that's sort of how the strategy formalized.
Right. Okay. So if we just sort of take a step back, there's been a meaningful growth in the types of business that you're talking about, private credit, and specifically private real estate lending. Worldwide over the last 15 years, came off the back of the 2008 crisis and the shutting of the window by the banks. Tell us specifically how this sector has developed in the Australian context.
I think that the narrative is somewhat similar to the rest of the world, whereby the banks domestically have become increasingly hamstrung by regulation. And something that I think is somewhat unique to Australia is that it's been also hamstrung by politics and popular opinion. Anytime you see a bank enforce against anyone, there is a woe is me article that comes out in some publication and ultimately gets national attention. Right. And so as a consequence of that, the banks really have pigeonholed themselves to the lowest risk cohort of borrowers and assets in Australia. And as a consequence of that, that left a reasonably scalable gap in the market for which private credit has come to fill over time. That's probably where the overlap is. The second thing is that the emergence of American-led funds management platforms like Apollo, Ares, Atlas, and similar names, KKR, Blackstone, I think also led to a rapid maturation and establishment of the ecosystem. I think you go back 10 years ago and it barely existed, and 5 years ago it was relatively robust. And today you're starting to see some signs of increasing sophistication and maturation. Not to say that there isn't still very high information asymmetry and pockets that are still ill-established, which is really the areas that we try to focus on. But it's certainly come a long way very quickly.
Right.
Yeah, it's interesting. I'd like to say it is probably less developed, obviously, than the US and Europe. I mean, I think it's fair that most probably people would see that. Partly because it's a function of, I guess, our fixed income capital markets in Australia is, it has been less developed here relative to the US and Europe, largely just due to the concentration of our banking sector, which I guess has led to really fixed income capital markets being far less developed relative to the US and Europe, which has probably been part of the reason why it has not emerged as quickly as perhaps in those more developed jurisdictions. Having said that, as John mentioned, our banks have still not been immune to the global regulatory standards that have been imposed post the GFC, which requires obviously even our banks to hold more capital provisioning against activities which are now being taken by private credit providers.
Good.
So I'd say the last point of distinction, and it is an important one, sorry to interrupt, is that whilst I would say that private credit in America means a lot of different things, and there's sort of a very broad and deep ecosystem, in Australia, when you say private credit, it really means real estate.
Yeah.
And it's not to say that there is there are non-real estate strategies, there are asset-backed warehouse finance, which is of course part of our strategy, and part of the reason why we focus on those areas is because there's not a great concentration or depth of capital outside of the banks that focus on subscale lenders within the ecosystem. But I would say, to throw a number that I'm picking out of thin air at the I would say it's sort of 70 to 80% of the ecosystem.
Right. Okay. So now, given the sort of that 10-year history, sort of going back to post GFC, Great Financial Crisis, then through to some of the foreign lenders, the big ones coming in, what did you see as an opening in the market, and how is HCP going to be, or is it addressing that demand that you spotted?
So I would say that the demand that we first saw is somewhat distinct from the demand that we see today. What we first saw was really an ability to generate outsized returns in the senior part of the capital stack. Now, today, as a consequence of some of the factors that we just discussed, being the maturation of the industry, concentration of capital, and frankly, the rapid formation of capital as a consequence of both private wealth platforms, superannuation industry, and American funds management platforms setting up domestically, there are pockets of the market that are very crowded. And there are pockets of the market that are quite inefficient. And where you sort of see that delta is between the large institutional end of town, particularly within construction development markets, and then the very small end of town, which is really where we try to remain focused on.
And define small end of town for me.
Sort of between $1 to $25 million transaction sizes.
Right. That is the full equity stack, or that is the debt stack?
Debt stack.
The debt stack. Okay. So in the small end of town, there aren't a lot of people who are operating. And so given that, what's the strategy that HCP is pursuing?
Well, yeah. So, and as John mentioned, I think, we feel that the type of sponsor and, I guess, underlying borrower here tends to be more of an SME, like small to medium enterprise style borrower, as opposed to what John mentioned. There's clearly a much larger supply and entry of capital into that larger sponsor style developer position. And that's largely driven by the fact that, I guess, the funds which have come in of the ilk, which John mentioned, particularly those American funds, just need to deploy a certain check size every time they need to do a loan. So it's therefore very challenging for them to really address, given their resource and capacity, the smaller end of the market, which is a less sophisticated sponsor, typically might be a small business owner or a small corporate. But having said that, the collateral which they're prepared to offer is real estate in nature, right? Because the reality is, going back to why real estate forms such a dominant part of the private credit landscape in Australia. It's just such a critical component and part of the Australian economy and ecosystem. And the demand for the underlying end product is so voracious that ultimately financing has to gravitate towards it.
Well, but, Cyril, I might just argue it's simply just the supply of land in Australia is so vast. So that would that's a guy coming from a small country on the other side of the world. Right?
That's right. But there's also, I think we all know, and it's a very Australian thing, certainly a cultural obsession with real estate, which I suspect a lot of our friends and allies would find very strange, but it is what it is. So that I expect is also a big driver around it. But yes, look, so that smaller side of things, look, there is competition. I think certainly it's still immature and competition has emerged, but certainly far less competition and far less availability of capital, at least. And so as a consequence, there are also an ecosystem of originators and managers in that small end of the spectrum, which not many people are familiar with. And so as a consequence of a function of both higher degrees of information asymmetry and lower availability of capital, that's where I think, by deploying capital, HCP deploying capital in those areas, potentially you're able to achieve better risk-adjusted returns than potentially the more crowded segments of the private credit landscape, particularly construction finance.
Right. Okay. And Jonathan, talk to me a bit about the factors that you look for when you assess a deal. Give us a sort of typical box standard deal, if there is such a thing, and then how you go about thinking about it.
So the vast majority of the deals that we look at are very much asset-driven transactions. And what that means is simply to say that there may be income, but there's not sufficient income to service the type of debt that we're able and willing to provide. And so as a consequence of that, you're really looking for a catalyst to realize your loan. In other words, to get repaid. And those catalysts have various factors, but ultimately you're dependent on the sponsor to deliver on whatever the repayment strategy is of that loan. And that could be, something that's sort of outside of the structure that you remain line of sight, that you have line of sight to, or that could be a sale of the subject asset. So the first thing is quality of sponsor. Again, I think at this part of the market, information collection and direct line of sight is very difficult. Brokers tend to dominate those relationships and don't really want to give up the keys to the kingdom, so to speak, by making the connection, but we have to insist on it. The second thing, and this is probably where we differentiate ourselves to some degree versus other lenders within the sector, is a very strong proprietary view of the asset value. And for us, that definition has a very specific meaning. And that meaning is to say that with a reasonable to high degree of certainty, we can ascertain within a 5 to 10% margin for error the asset clearing price of that asset. And the reason why that's the way that we think of the definition is that you have some asset types, call it residential housing, where within one standard deviation of median house pricing, it's reasonably homogenous. And as a consequence of that, they're relatively deep and not always liquid, but there's a deep set of consistent comparables that you can point to say, look, there was X number of purchases on this, and this is how many days it takes to sell, and these are the costs usually associated with the realization of that asset. And then you might have something more esoteric, like a cold chain storage industrial asset, between Sydney and Canberra. And it doesn't necessarily diminish the criticality for that asset, but it's a limited user pool, limited tenant pool, and potentially limited buyer pool as well. So, it's not to say that we won't lend against those assets. It's simply to say that if we can't ascertain their value within a reasonable degree of confidence in most market conditions, we won't do the transaction.
Right. And so what else, what are you looking for when you're looking at these deals? What are the decision points or the sort of key factors?
Yeah, so I think obviously key thing is that there has to be typically a commercial or investment purpose. Obviously, some kind of collateral which is reasonably liquid in nature, which, as John had mentioned, we can have confidence in terms of ascertainment of clearing price and value. Sponsor quality matters as well. I guess typically where you have an asset-rich but cash flow poor situation, realization and execution of the proposed loan repayment strategy becomes ever more critical, right? Sure. So I guess high quality sponsors, either with high net asset positions or better business experience or prior professional experience, will typically be able to execute on their kind of proposed loan repayment strategy. Now, typically the most professed exit strategy is that, upon use of the loan that we provide them, it will substantially enhance the cash flow and earnings of their business, for instance, which will then obviously potentially procure more refinance options of our position. So that's one potential exit strategy. But there's also, an emotional and commercial maturity for them to accept that if in the event that doesn't transpire, that they will proceed to some kind of asset realization or realization strategy for the collateral to repay our loan. So, I think really, as I think John alluded, crystallization of value, assessment of value, but more importantly, enforcement and I guess management of exit strategy is critical, particularly for these situations which are asset rich but cash flow poor. So.
Okay, and when you look at sort of the supply demand dynamics in that market segment, the million to 25 million that Jonathan was mentioning before, what are you seeing at the moment? Are you seeing lots of demand? How is that translating into pricing power, and who are you competing against?
So at the moment, there's a very high demand for the type of credit products we provide. There's also a reasonable degree of competition, and frankly, there's more competition, I'd say, and I anticipate more competition coming into the space. And as a consequence of that dynamic, the pricing power is very situationally dependent. And what I mean by that is the type, it will depend on the sponsor's circumstance. So, how important is timing? How important is leverage or the amount of leverage to them? How important is the quality of the counterparty? Because there's very mixed reputations within the sector. And as a consequence of that, there will be situations where you can really, price not however you want, but reasonably aggressively with a high prospect of winning that transaction. But for the core of our strategy, which is 60 to 70% of the transactions that we do, which are very low leverage, bridging, mortgage-backed securities, I would say that we have diminished pricing power. It's sort of very much dictated by the market. The only advantage that we have there is very high degrees of information asymmetry. So it's very tough to know what the average price at any given point in time is. And so as a consequence of that, at times you might just have a borrower or an advisor that's not that across the space, and so you might win a transaction that way. But to answer your question more directly, there's limited pricing power within that core, and it's sort of trending downwards. And my expectation is returns and margins will continue to compress.
Right, and does that push you strategically towards what may be a higher risk type deal where maybe the underlying borrower is reputationally not as strong, or the underlying asset is not as easy to clear, if you need to enforce?
It's a really good question. I would say that actually it's the opposite of that, which is simply to say that dispersion of returns is incredibly low. And what I mean by that is simply to say that risk premiums are de minimis within the Australian market at current. And so, you can do that, and you can lend to a worse or a lower quality sponsor, or you can go up and leverage, but you might only earn another 50 to 100 basis points in return. So as a consequence of that, even though we are seeing returns compress, we would rather go lower down the risk curve, simply because we still think that whilst it's disappointing to see returns compress and base rates go down and everything else, we still think that it represents the strongest risk-adjusted return. And frankly, it's still, I think, a good return, being high single digits relative to the risk that you take.
Right. Yeah, it's interesting. I mean, I think from a demand standpoint, I think firstly, there have always been asset-rich but cash flow poor situations, which banks will not service. So, I mean, that was part of the reason why the factoring industry was born out, in Australia, for instance. And it looks like increasingly so, given the bank's requirements and conditions to bank SMEs are becoming just more challenging from a capital intensity standpoint, but also from a servicing assessment standpoint, right? So, but as John had mentioned, what absolute yield you earn in those situations at any point in time is situation dependent. If in case obviously the yield curve starts to lower in Australia, then obviously there will be a compression in the overall total yield. But having said that, I mean, even if, at the moment we're generating a low double digit yield, which is very healthy, obviously, and we would suggest probably is a deer in a situation. But if you're generating a high single digit yield, for, largely asset, 60 to 70% asset backed gearing against, quality liquid receivables and asset security, I would suggest that's still quite a reasonably good, long-term risk premium and healthy long-term risk premium in the long run.
So. Got it. Okay. And Cyril, how do you see the market developing over the next few years? There's been obviously a lot of players come in, the market's maturing. What does the market look like 2-3 years out from now?
Well, it is maturing. I mean, it certainly has matured a lot compared to when I guess I started and John started doing this. I mean, it's funny when I started doing this back in 2012. Before private credit, because I guess it wasn't even known then as private credit in some ways. So I guess people would tell I've been doing this before it became, I guess, glamorous.
It sort of reminds me I was in the tech market before anybody anybody knew, and my mother would go, "So what is it that you do?" And like, I don't know.
Suddenly it's like, the fact I'm even doing a podcast, my wife just, you've been doing the same thing for like, for as long as I've known you. What's so different and glamorous? But look, I mean, as I said, I think, what will I think potentially happen? I mean, look, you're right. I mean, the fact that M&A activity in particular has started in Australia is obviously a sign of its maturation. I mean, Apollo obviously bought a 50% stake in Max Cap. Merix was just recently purchased by Regal Funds Management. HCP Capital purchased a construction financing called Payton Capital down in Melbourne. Centuria bought Bass Capital in order to establish a private credit construction platform themselves. So clearly, Capital went purchasing Wingate recently, for instance, right, to get an entry point to deploy construction finance. MA Financial just did a joint venture with Warburg Pincus. So clearly, that's a sign of a more mature industry as a consequence of that M&A activity. What I do expect, though, is, for instance, warehouse asset-backed lending, which is what we are focused at. Smaller spend spectrum will continue to grow and develop because it's probably a segment that is still relatively undeveloped in the private credit ecosystem in Australia, particularly warehouse or wholesale finance facilities to emerging specialty credit providers or private credit managers, which don't have the ability to obtain institutional bank funding. I guess also potentially what is more traditional in say US and Europe, that more corporate lending, where lending to corporates, potentially may develop a little bit more. It's still a relatively undeveloped area in Australia, relative to the US and Europe as well. But in terms of real estate and asset-backed lending, I would suggest kind of what I guess HCP is engaged in, really doing wholesale finance or partnering with I guess, emerging specialty credit and private credit providers, and essentially lending into pools of receivables or asset-backed loans, essentially.
Right. Okay. And just sort of to round off the conversation, Jonathan, in terms of the sort of broader macro, are there factors there that keep you awake at night as you look at the book of loans that you have?
I think you've known me long enough by now, Darren, to know that there's 100 things that keep me awake every night.
But I don't want to discuss any of those. I want to discuss this.
I don't know what this says about me, but 90 of them are macro. But look, to distill this down specific to what we do, there's probably two points that are worthy of consideration. The first is that residential assets, and this is very much a global phenomenon, but I think it's particularly acute in the capital cities of Australia. Residential asset values have become completely disconnected from their economic utility and from underlying incomes. And so that's simply to say that when we provision a loan against a residential asset that might be, say, 60% geared, which sounds reasonably conservative on paper, for it to become realigned with the underlying user or the sort of deepest part of that market, it actually has to fall a lot more than 40% for that to sort of be considered reasonable pricing by historical standards. And that's not to say that it can happen, but there's also nothing to say that we shouldn't be saying that that would necessarily happen. But there are historical precedents for it, and something that I'm quite conscious of. And then the second thing, although I do think that there's probably a positive interpretation to this as it relates to us, is pending regulation to the space. And the reason being is that at the moment, private credit sits within a regulatory black hole domestically. It's something that's being increasingly discussed. As a matter of fact, just yesterday, ASIC published a discussion paper in sort of considering a roadmap for regulation of the private asset ecosystem, but specifically mentioned private credit as requiring further regulation. Which body will ultimately take hold of that is not clear to me, because it kind of sits within a few regulatory bodies, but I suspect that will sort of start to evolve over the next 2 to 3 years. I would say that net from my perspective, it's probably a positive for good actors within the sector, and a net negative for some others.
Yeah, just a bit of a cost overhead and somewhat of a pain in operations. So yes.
Correct.
All right. Well, that's really really fabulous. Jonathan Moss and Cyril Pham from HCP, Harbour Capital Partners in Sydney, Australia. Thank you very much for being with us on Definitely Uncertain.
Thanks, Darren.
Appreciate your time. Thank you.
Okay, thanks so much. And for all of you listening out there, you can get more podcasts coming your way soon. And thanks for listening. Bye-bye.